An interview with an investment banker.
You're an investment banker.
That's right.
In this interview, I'd like to cover the three areas of investment banking: IPOs, M&A, and raising funds. I'd like you to explain a little bit about each one.
OK.
Let's begin with an IPO, initial public offering, where you take a private company to the stock market for the first time. Can you tell me the role of the investment bank in this process?
Yes. First, we have to find a promising company that is ready to go public. Often we're approached by whoever owns the company, usually a private equity firm. They come to us and say they have a company ready to go public. Then it's our job to decide on the price that we will ask for the shares when they're listed on the stock market on day one. And finally, it's our responsibility to find buyers for those shares, large financial institutions.
What about underwriting?
Yes, underwriting is making a guarantee that we will sell all the shares. Of course, we do the underwriting. If we can't sell all the shares, we have to buy them ourselves. But normally we know beforehand and we ask the company to reduce the number of shares it will make available.
Is there anything else that you do?
Well, at the beginning, a lot of time is spent doing due diligence. That means checking everything: the financial statements, the rules of the company, the background of the senior managers, and many other things. Everything has to be legal and correct before the regulatory body of that stock exchange will accept a public listing.
OK, so that's the first area of an investment bank's work, IPOs. Let's move on to the second, mergers and acquisitions.
OK, a company might come to us and say they are looking for another company to buy. Perhaps they want to expand or to enter a new market.
And then you look for a suitable target company.
Yes. We approach the target company and see if the major shareholders want to sell. And if they do, we do due diligence on both companies.
Who decides what changes there will be after the acquisition? For example, which offices will close, who will lose their job, etc.
Well, the senior management decides, but very often they bring in a consulting company to help them. We don't do that.
OK, and now the final area of an investment bank's business is to raise funds for its clients, either through issuing new shares or through issuing bonds.
Yes. Of course, there is a third way to raise funds, which is to ask for a bank loan, but that isn't our job.
Right, so what happens?
The company comes to us and says that they need to raise money, and we discuss with them which is the best way. A new share issue means the existing shareholders might not be very happy. Their stake in the company is diluted, and their dividends are diluted. But if it's to raise money for expansion, then it might be okay. A bond issue is different. You are raising money with a loan. It means that the company takes on more debt, which has to be repaid.
What is the advantage of raising money through debt?
It costs less for the company. If the company has a good credit rating, it can issue bonds quite cheaply.
OK, so my final question is this. How does the investment bank get its income in each of the three cases?
Commission, in all cases. We get a commission for a successful IPO, a commission for a successful acquisition, and a commission for a successful share or bond issue.
And does anyone else get a commission?
Oh yes, accountants and lawyers and consultants. There are always accountants and lawyers and consultants.